meeting on the topic Recent Judicial Developments Focus on Section 68 and 69D Judicial Enhancements. And to dwell upon this subject, we have Siddesh and Gaddi. May I request the Chairman Sir to please escort the speaker for the day and welcome him with the floral bouquet. Thank you, Chairman. Members, it is a privilege to introduce today's speaker, Siddesh Gaddi. He is practicing in Bangalore since 2018, qualified in the year 2015. Practicing in the field of direct taxes, he is mainly into litigation practice and has represented at various levels. His focus includes transfer pricing and international taxation matters. Partnered with Ramesh Ashwin and Karnataka, Bangalore. Was partnered with NCS and Court Bangalore and Karkara. He earlier worked with consulting firms at BMR and Associates, litigation firms at K.K. Chaitanya Law Firm. He is a co-opted member at the Research Committee and Exposure Draft Committee at the SIRC of ICI. He is actively associated with Bangalore Chartered Accountants Toastmasters for over 3 years and a president of the club in addition to learning. He has co-authored articles on contentious issues in transfer pricing matters. He is a regular visiting faculty at ICAI and a speaker at CA study circles. He has addressed over 25,000 chartered accounting students and over 2,500 chartered accountants. He is also a regular visiting faculty at ICSI and GC Rao Academy. With this brief introductions, I present before you Speaker C.A. Siddesh and Gaddi. Over to you, sir.
Chairman, Bangalore branch, Manjunath sir, for this opportunity. Also like to extend my warm greetings and gratitude to the Secretary, Tupad sir. If not for this opportunity, this academic indulgence of getting into this section, which is almost 5 decades old, if not for this opportunity from Bangalore branch, this highly contentious, most litigated sections. In fact, 1 out of 3 orders which I get for litigation purposes, for filing appeals before CIT or ITAT, it is based around these sections. The most triggered sections. That's why I would like to call assessing officers as trigger happy. They would like to invoke section 68 to 69C for anything and everything. We all know the reasons. The highest possible tax rates are around these sections. So I have more than 175 slides to be covered in next 2 hours. With the permission, I would like to proceed with the first possible slide. I would be doing injustice if I don't touch upon 115 BBE before venturing into 68 to 69D. So by keeping pleasantries short, the first possible section I would like to touch upon is 115 BBE. The extract of the section, I could afford to put extract of all sections which I am dealing with onto the slides. The reason being 68 to 69D hardly covers one page or 2 pages in the Income Tax Act, which is running 2,500 pages. Am I right in saying these numbers? 68 is hardly running into 5-6 lines. The preamble, coupled with a couple of provisos. 69 is even more smaller. So I could afford to have the extract onto the slide itself. A quick summary before we venture into the nitty-gritties of this particular section. Has just about 2 subsections. Subsection 1 is dealing with, subsection 1 clause A is dealing with instances where assessee can on suo motu basis offer income under these sections. It is nothing less than a joke. On suo motu basis, assessee is offering income under section 68 to 69D. We'll touch upon that. Subsection 1, clause B is dealing with instances where assessing officers bringing about addition to the returned income under these sections 68 to 69D. And natural consequences, members, it's listed there. Roman number 1, tax rate is very obvious, 60%. And any other income apart from 68 to 690 is regular taxation. This we are quite aware. Subsection 2 is also equally litigated, though it is very small. 3 things are frowned upon, one being allowance, second one being expenses, third one being set off of losses. Be it income assessed under clause A of subsection 1 of 115DBE, which is income returned by the assessee, or be it income assessed by the assessing officers. So this is the structure of the section, and we have to break it down into, if I can summarize what it was previously and what it is now. Prior to the amendment, the tax rates for incomes assessed under section 68 to 69D was 30%. Surcharge, depending upon the total income of the assessee, cess, we all know what it is. Roughly around 35% was the tax rate. In hindsight, maybe back in those days, I would have found it equally difficult to convince assessees to pay 35% tax rates. That's a different matter. But in hindsight, looking at the rates that are prevalent today, it's a huge discount. Post demonetization, that is when the amendment has come into play. Tax rates is 60%, surcharge we are all aware it's 25%. Cess we all know it. It results to the base rate, tax rate without interest and penalty itself is 78%. And in the previous slide we also saw the classification under subsection 1, one being returned by the assessee, second one being assessed by the assessing officer. In cases where income is returned by the assessee under section 68 to 69D, there is a benefit in terms of penalty. 271 AAC penalty, as if it was a nice incentive that was being given to the assessee. The penalty there is 10% of the tax referred in 115BBE. What is the tax in 115BBE? It's 60%, 10% of that is 6%. So assessees voluntarily filing return of income, disclosing this particular income, in the view of penalty of how much? Penalty of just about 6%. So this is the incentive which is being given to the assessees if you do voluntary disclosure. And that too, for this particular disclosure, you got to file return of income within the due dates mentioned under section 139. Basically covers everything. Subsection 1, subsection 4, 5, 8A, rectification return, subsection 9, defective, whatever it may be. And moreover, the second condition is 271 AAC. The second condition is taxes have to be paid before the end of previous year. It is the previous year, not even the assessment year. So that 6%, just to earn or rather save 6%, you want to do all these things. Or maybe, if I can give an example, I've been constructing a house since last 3 years. 50 lakhs is being infused, unaccounted money, over the last 3 years. 50 lakhs each. 1.5 crores is the unaccounted money put together. If the assessing officer were to invoke assessment proceedings and bring it to tax, the tax has to be brought to, the income has to be brought to tax in the respective years. So had it been brought to tax in the first year, the interest under section 234B and C, maybe there is a scope for me to save this interest under 234B and C by offering it to tax in the 4th year. This 1.5 crores, I can offer it to tax in the 4th year and end up saving tax for the last, rather interest for the last 3 years. So this window has been provided. To what extent you want to use to save interest and penalty is left to the assessors. But tax rate remains the same, it is 78%. So this is just a summary, a couple of interesting issues when it comes to subsection 1. As I mentioned, the trigger happy assessing officers. The moment there is an addition to the returned income, the inclination is it has to be brought to tax under section 68 to 69. If not for the purpose of those sections, at least for the purpose of 115BB, tax rate being the highest. So especially we get to see these instances when it comes to the search cases and the survey cases. Any income surrendered by the assessee during the course of survey or search, the inclination is 68 to 60/90. But there is a provision, there is a possibility of we carving out that particular income from these sections. And it is only when these sections are attracted, 115BB can be invoked. As simple as that. You all can appreciate this point. The second point listed on the slide, as if the tax rates under section 115BB was not enough, we also have Foreign Black Money Act. I'm sure members in this class will appreciate, in this room will appreciate the tax rates under the Foreign Black Money Act. What is it? What is the tax rate for undisclosed foreign income and asset under the Foreign Black Money Act? It's just about 30%. 30% is no doubt very good when compared to 78% or rather 60% under the Income Tax Act. But the penalty under black money is 3 times, rather 300% of the tax. So it is 90 plus 30 plus interest plus penalty plus prosecution. You all know how lethal it is, how brutal it is, Black Money Act. So it is 120% plus when it comes to Black Money Act for foreign undisclosed income and asset. 115BB is much better. If we have to compare, 115BB is much better. If there is a conflict of application of section 115BBE versus income that is to be taxed under section under the Foreign Black Money Act, the Foreign Black Money Act is quite clear. I have reproduced subsection 3 of section 4 of Black Money Act onto the slide. The income is out of the scope of income tax if it is hit by Black Money Act. So the summary here is based on first point and second point. First point, when it is 28 business income versus 68, whichever is higher applies. At least that is the approach of the revenue authorities. If there is a conflict between Black Money Act and Income Tax Act, again whichever is higher applies. Black money being 120%. Anyways, this 115BB is a recent introduction. It is in 2012, it has come into force. The reason for amendment in 2016 was due to 2 reasons. One is the low tax rate, we all noticed it in the previous slide, and the provision for so-called voluntary disclosure of income was not there in the previous regime. It has come into play only after the amendment in 2016. And this amendment has been given some sort of retrospective effect by the Taxation Laws Second Amendment Act 2016, which has come into force from 1/4/2017. Received the presidential assent on 15/12/2016. These dates are important. So this is not something which has come prior to the commencement of financial year. This is not something which has come by way of a finance bill, finance act. This has come into play during the financial year when the incomes were being earned post demonetization. That is what it has been introduced. Almost after half of the financial year was gone past, this amendment has come into play. We will deliberate on that in the subsequent slides. The last point listed there refers to 115BBE subsection 1 clause A, which we just referred a while back, suo motu additions by the SSC. We come across many charging sections under Income Tax Act, starting with 15, 22, 28, 41, 50, 56. In none of these sections you find mention of a phrase called as to the satisfaction of assessing officer. But 68 requires a satisfaction of assessing officer. We also have come across a lot of computational mechanism. Section 29, it's all listed in the subsequent slides. None of this computational mechanism requires a satisfaction of assessing officer, but for one section, section 48(2)(b), reasonableness of expenses claimed by the SSC. So how is that we can plan the satisfaction of assessing officer on suo motu basis in the return of income to be filed by the SSC? There is one section which I am reminded of, section 14 capital A, subsection 1 used to deal with some sort of suo motu addition by the SSC. Subsection 2, there required satisfaction of assessing officer. But section 68 has no option, satisfaction is required in the very first instance. How is that SSC can bring about that? I think some changes are made to section 115 BBE without any corresponding changes to section 68 to 69B. While 115 BB subsection 1 clause A, you can offer income, undisclosed income in whichever year you want. But section 68 is very clear. Income found credited only in that year addition can be made. So that mismatch is there, yes, discord is there. But nonetheless, I don't find it's been close to about 2016 amendment, it's been close to about 9 years of introduction of this voluntary disclosure, some sort of settlement scheme, some sort of VSVS scheme into the act without any expiry date. Not even one return of income, not even one assessee I have come across having opted this in the return to be filed under section 139. So that's why my initial remark was this voluntary disclosure is a joke on the assessees. Who will pay 78% taxes? How is that we are going to convince assessee to pay 78% tax? Thankfully, the validity of the amendment 30% to 60% was challenged before multiple courts. Only one court has rendered findings, Delhi High Court. The basis of challenge is something to be appreciated. Petitioner had raised apprehensions with respect to subject to exercise. So what is required under section 68 is satisfaction of assessing officer. It is the discretion of assessing officer which is required. How is that you can leave assessees to the mercy of assessing officers? This is the apprehension. First, unfair treatment among the similarly placed assessees. High tax racket is prone to abuse is the argument that was placed before the Honorable Court. The ruling is an act cannot be held as unconstitutional based on fanciful theories or apprehension of misuse. Validity is upheld as of today. But I see Gujarat High Court is filing all the litigations, all the petitions by granting some sort of interim relief. The order is still not out. As of today, law of land is, we got to comply with this. There is an order on 115 BB, pay up taxes or file a writ petition before the time. So I was touching upon a couple of dates in the previous slides. The amendment coming into play mid-year in the month of December, President assent on 15th December 2016. So there could be a possibility of assessees earning income in the month of April, which is subject to tax at 68 under section 68 to 69B. What is the fate? Do they have to pay taxes at 30% or 60%? This is a question which we are going to deliberate in next few slides. We should all appreciate this cardinal principles, rules of interpretation as to when section kicks into play. Section 115 BBE, the amendment clearly stated that this is applicable from 1/4/2017. It was evident from the Finance Act, not Finance Act, Second Amendment Act. So the cardinal principle which has been laid down time and again is that it is not the law which is applicable during the financial year, during the previous year rather. It is the law which is applicable on the first day of assessment year is something to be applied on the assessee. This is a cardinal principle. No debate around it. To further support the finding which was there in the previous slide, we have a few more landmark rulings. One I can touch upon is fairness in taxation as emphasized by Vatika Township, very landmark ruling on section 113. In the case of Vatika Township, it also held that a new levy, additional liability cannot be cast upon the assessee in a retrospective manner unless law holds it otherwise. The second sentence is important, the exception is important. If the law is very clear that this has to be given retrospective effect, so be it. If it is not so, it is to be interpreted as prospective in nature. That's the interpretation. That's the summary gist of all the citations which is put on the slide. This being, despite this particular understanding for about 1961 Act, 1922 Act, rules of interpretation, despite this particular understanding around how a law has to be interpreted, we have this ruling from Surat Tribunal. If Surat is not enough, we have a few more tribunals which are listed on the slide. They have given interpretation stating that this amendment is not retrospective, meaning the incomes earned prior to 1/4/2017 based on these rulings are not liable to tax at 60%. So all demonetization cases are out of the purview. All demonetization cases can go in the VSVS 30% tax, they would be so happy. This is the interpretation. I'm sure even assessees, having been burdened with litigation for about last 6-7 years, demonetization, we got orders in the month of December 2019, we are in 2025, May, still orders are pending. So assessees, if they have this interpretation, they would be happy to pay taxes at 30% plus interest and penalty as before. So one such ruling I have put it on the slide. The basis of ruling, I highlighted it. Indoor bench has considered the fact that search in this case was carried out before the amendment. So the assessing officer invoking section 115BBE provisions, which came into force only on 1/4/2017, is the interpretation of us. Where is cardinal rule? Where is Vatica? Where is the power of a parliament in implementing a retrospective amendment? Anyway, this is the finding given by the indoor bench. Siddesh Kumar Jain, again Jabalpur. I didn't know Jabalpur also has a tribunal, but nonetheless we have a nice ruling. I've highlighted what is important. It was necessary for me to put the entire text onto the slide. Maybe down the line it is shared by the Bangalore branch, you can refer this, but I will only read what is highlighted, underlined. So on 30th of November 2016, after demonetization, this assessee was subject to survey. Assessee surrenders some income, 133A case. He surrenders income. Because the surrender was made prior to the amendment, the interpretation is 30%. What an interpretation. The rulings I have been referring so far is 2021 and 2020, latest. This is hardly 1 week old. Not even a week old. All the ITT are now on vacation. It is just before vacation. Reiterating what has been reiterated or the findings given in the previous slides, that it is only prospective in nature. It does not affect incomes earned during demonetization and prior to that. But I take comfort of this Kerala High Court ruling. Not Jabalpur, not Surat, not Indore. Kerala High Court. I stress this, it's a High Court ruling. Has held that this provision of 115BB, this is bad news for assessees. It is retrospective in nature. What has been emphasized here is the liability to pay taxes under 115BB existed since 2012. What has happened by way of second amendment to Income Tax Act in 2016 is only increment from 30% to 60%. So the opinion of the High Court is, it is not a new levy, it is only increase in taxes. So I feel this will prevail. If the constitutional validity of 115BB is upheld by other courts, this will prevail. Then it has got retrospective effect. Chennai ITAT is also Chennai again, not Indore, not Surat, not Jabalpur. Chennai ITAT. Chennai is loaded with cases. ITAT has also appreciated the fact that there is no new liability. This is applicable from assessment year 17-18. I would like to reiterate the important point here. The amendment has come into play on 15th of December 2016. Close to about more than half year had gone past. And many assessees, look at the predictability is not there. Where is taxpayer charter? Where is fairness in taxation? You earn income thinking that it is 30% liable to tax. Then you are invited with a notice of 78%, not even 60%, it's 78% with surcharge and cess. Where is fairness? Where is taxpayer charge? It's all on the board. Where is the board? Right next to the lift of the income tax department. Where is it in practice? Anyway, so we have to live with this law. The observation there is to be appreciated. This is to appreciate the interpretation of law. I have highlighted what is important. Again, under ordinary circumstances, that is what Vatica Township had held. Under ordinary circumstances, Act does not have retrospective operation, especially when it comes to substantial rights, substantive provisions. This rule is not unalterable. The language may give an enactment more retrospectivity. So that's the nitty-gritties on section 115 BBE. Subsection 1. Subsection 2, we had a debate on set-off of losses. The set-off of losses, if you remember, out of 3 things that were barred under subsection 2, allowance, expenditure and set-off of losses. This set-off of losses is a recent insertion to subsection 2, otherwise it was only allowances and expenditure. This is also an invention of Finance Act 2016, but the assessing officers were also applying it to the previous assessment years, prior years. Lot of litigations I could have just listed on 2-3 slides of case laws, but anyway CBDT, sense has prevailed. CBDT has come out with a circular stating that it is to be given prospective effect. It is applicable only from assessment year 17-18. So no litigation around it. We are getting relief even by way of rectification order. Forget appeals. Subsection 2, again there was a need for corrigendum. In the Finance Act 2016, they didn't realize that they had addressed only clause A. So the first part, the bar that was placed, it was placed only on clause A, subsection 1, 115 BBE. That is dealing with offering income on suo motu basis. Only if income is offered on suo motu basis, you are precluded from claiming expenditure, set-off of loss and allowance. Unfortunate, there was no reference to clause B. So if assessing officers adds any income, there is still a possibility of claiming set-off of losses. So that has been plugged again by doing what? By doing retrospective amendment. It is with retrospective effect from assessment year 17-18, amendment which has been introduced by Finance Act 2018. Not surprised so far. Even otherwise, it was my opinion that it's a deemed income. There was no bar on the, there was definitely a bar on the assessees in claiming all this expenditure, allowance and set-off of loss. So this is my take on section 115 BBE. Coming down to the section that has been allotted to me, the case laws that I am supposed to deliberate upon, section 68 to 69. By and large, these provisions have come into place from Finance Act 1971. So it's been close to about 5 to 6 decades of existence. Despite these provisions being there under the provisions of Act for about 6 decades, has it achieved the purpose? Is the question left to the audience. I have a different take on that, but nonetheless, even prior to introduction, there are case laws holding that additions could have been made for unaccounted income, income without source, unaccounted or unexplained expenditure. Additions could have been made even without the sections. Very important case law which I put it on the slide is that of Delhi High Court. Yadu Hari Dalmia is the case. I would like to stress this because it is often noticed that many SSCs resort to some sort of legal argument in approaching these sections than fighting it out on merits. If I am successful with my legal argument in taking it out of the clutches of section 68, addition can still be made. That is what this case was all about. So what has been referred on the slide is section 69C. Court is very clear, it is put in italics because this is the extract of the ruling. Court is very clear that it is only clarificatory in nature, embodies a rule of evidence which is even otherwise quite clear. It is there in the Act. It is not that you can disclose any random income under the head PGBP and get away with it. If there is no source, it can be brought out of the income tax and from the PGBP head of income and taxed elsewhere. Maybe other sources taxed under section 115BB. Same is the observation around section 69B. Same is the observation around the 68. What has been highlighted again in red is to be appreciated. Introduced into taxing enactments step by step in order to plug the loopholes. So 69 was there in Acts ever since 1961 or even 1922 for that matter. That is in order to place certain situations beyond the doubt, even though there was judicial decision covering some of these aspects. This is the observation. So end of the day, the stress, the focus on only legal ground should be avoided. The strategy should not be around legal ground. The strategy should can also be around the merits of the case. So how is that we can address merits of the case? Section. Section is reproduced on the slide. The approach I would like to adopt is, because it is a small section, I could afford to have it on the slide. But with your permission, members, phrase by phrase, if not word by word, we can address this section, because every word which is there in this provision carries some sort of weight. It is only by interpreting that we can help assessees in coming out of the clutches of section 115 BBE, having tax rate of 78%. So section, a quick read of section: any sum which is found credited, I can even say it by heart. Any sum which is found credited in books of accounts of the assessee for any previous year, and the assessee offers no explanation about the nature and source, or the explanation offered in the opinion of assessing officer is not satisfactory. In that case, the consequence is the sum so credited may be charged to income tax as income of the assessee of that year. Every word I would like to emphasize in a very slow-paced manner, provided time permits. This is first proviso, equally dangerous. First proviso, recent invention of the department. Second proviso is lethal, draconian, brutal, to say the least. Third proviso is blessing to the assessees. Third proviso is the only piece of legislation among the sections that I am covering where there is no litigation at all. And guess what? Third proviso is a relief given by the department for venture capitalists registered under that section. Very small creamy layer of assessees are out of the purview of income tax, or under section 68. So section 68, if you have noticed, the heading of section is cash credits. And here we have assessing officers who make addition on share capital, who make addition on unsecured loans, trade creditors. But heading says 68 is cash credits. Quite misleading indeed. But the rule of interpretation is heading can only throw a light on the purpose of this particular section. Heading cannot control or dictate how this section has to conduct itself. Forget heading. If you go past heading, the first phrase which you come across when it comes to section 68 is any sum. Look at the words that are being employed. Any sum. So the interpretation is the second point which I am referring on the slide. It includes all credits, whether it is received by check or draft, irrespective of nature, whether it is capital receipt, revenue receipt, exempt income. Exempt income can also be targeted under section 68, has been targeted under section 68. We have seen cases around bogus capital gains, shares which are listed in stock exchange but disturbed by assessing officers here. In the recent past, in the Bangalore branch newsletter, I have written an article on agricultural income being taxed under section 68 to 69. Even agricultural income is not out of the purview of section 68. So it is any credit, very wide in scope. It includes loans, receipts, and any amount of similar nature. So the point I am trying to drive home is section is having a lot of powers to attack anything and everything which is credited, as long as it is credited in books of accounts. And whether it is a credit standing in the name of Akshay sir, or it is a credit which is standing in the name of Siddesh Gaddi in the books of accounts of Siddesh Gaddi, it can be taxed. We all know that there is a couple of case laws in support of that. Very interesting situation of assessee. It is unfortunate that assessee had to go to courts to be able to get this kind of relief. So I lend 10,000, that's the example. I lent 20,000 rupees to one Mr. B. And after 2 years, B returns that particular amount which is credited in my books of accounts. It's a money which I have got it back. Section 68 was applied to ask nature and source. My money, I have got it back. 68. And don't think that this is 1991 case law and has no relevance. In a refined manner, now assessing officers are asking these entities, credit cooperative societies, the cash that has been deposited in the bank account of the cooperative societies during demonetization or post demonetization. I have to explain the nature and source. They get money from DCC banks under various schemes, Kisan Credit, CMO, various schemes they lend it to the depositors. And when it is returned by depositors, especially during demonetization, they've been asked to prove nature and source. It's my own money. Don't you think this case law has balance when it comes to the live cases? Live cases. Even before tribunal, we are still fighting assessment as 17, 18 case laws, defending the fact that it is society's own money, or rather it belongs to DCC banks, which has to be returned. So, anyway, what is to be taken home here is, the point to be appreciated here is, it should be capable of being treated as his capital or income. If there is no possibility of treating it as capital or income, that credit cannot be subject matter of section 68. Remember, sir, I tried to break my head. If not for this example, I cannot think of a credit which is neither your capital nor your income. What else can it be? Is it a loan? Loan is anyway covered. What is not covered? What is the credit which is neither your income nor your capital nor the loan? What is that it can be? Anyways, this example definitely helps us to appreciate the analogy of the case. Again, even if it is a credit, it can still be out of the clutches of section 68 if it is only a book entry. First case law is anyway listed there. Second one is a journal entry, a mere journal entry. It is not a credit which is leading to infusion of cash into a books of accounts. So outside the scope of section 68. The last line needs to be appreciated. The analogy here is credits representing mere liability. Any examples? In the books of accounts of the assessee, if there is a credit representing a mere liability versus credit representing money received. My conclusion, based on the first phrase which we saw when it comes to section 68, is any credit, any sum which is found credited is restricted only to the second phrase here. Credit representing money received from others. It cannot be extended to the first leg, which is credit representing mere liability. Any examples in this? Not even a single example. It is there on the slide itself. Yeah. So imagine a plight of assessee. Current account. Yes, sir. Correct.
One room there, return of 1%.
That is book entries. Rightly said, there is no money that is being infused, so I cannot be called upon to explain the credit worthiness in that case. But hope sense prevails during the course of assessment and reassessment proceedings. And I'm sure many assessees, many representatives here will have come across notices asking you to explain trade creditors in the view of section 68. Take comfort of the case laws listed on the slide. So on trade payables, it is not something which can be gone untaxed under section 68. Even trade payables, if I have to stretch this example way too far, if the purchase itself is doubted, trade payables can still be subject matter of the preamble of section 68. Preamble is the first paragraph which we read there. Whether it is covered within the scope of first proviso, if time permits, we will deliberate down the line. So again, a couple of examples on I'm still on the first possible, second possible, first two words which is there in section 68. The bogus share capital, this company by name Rich Paints, this is 2021 ruling, had, for the sake of compliance with the SEBI provisions, past entries depicting some share capital, dummy issue. The assessee was called upon to explain naturally how can it be explained because it's a dummy entry. Thankfully, court Ahmedabad, the tribunal came to the rescue of the assessee. When there is no real credit, where is the question of explaining? But this cannot be our argument for anything and everything. If I am not able to explain an unsecured loan, I cannot say that it is a dummy entry down the line. Because back in those days, 2021, ruling or maybe the relevant assessment here, we didn't have the penal provisions around dummy entries, fake entries. What are the penal provisions? Listed down the line. 271 AAD and 277 AA, prosecution and penalty. What is the penalty there for dummy entries? Equivalent to the value of entry, as simple as that. So if I have to have a trade-off, section 115BB is 78% and 271 AAD is 100%. So I would never say that it's a dummy entry. Try to justify. You get a discount of how much? Penalty is there, interest is there, the discount is also gone. So it looks like this penalty is better off. To move on to the next phrase, section 68, any sum that is found credited. The purpose of found credited, or rather purpose of section 68, is to bring to tax something which has gone untaxed. This is the purpose, or something which is being shown as apparent but not real. I am trying to infuse my money into my business, that it is money received from CA Akshay, loan received from CA Akshay, but it is my own money. So this kind of transactions can be taxed. But of late, we are getting to see a very disturbing trend wherein assessing officers, the income which is already disclosed in section 28 under the head business income, they challenge us with a lot of queries which assessees naturally stumble because books of accounts are not robust, the documentation is not robust. Such things are being taxed. The first case law which I would like to cite here is ad hoc disallowance. DC Rastogi, it is 359 ITR 513. In this case, assessee had cash deposits of 17 lakhs. This is the amount, 17 lakhs here and there. Assessing officer, for I don't know for what reasons, he makes addition of 25 lakhs. So it's estimate, ad hoc disallowance to his surmises, to his whimsical fancies. It cannot be done to the assessee. 68 is very precise. Something which is found credited in the books of accounts. That's precise thing. What is in specific prevails over what is in general. So any addition, you say 20% of the cash deposits are doubted, I disallow that. That addition can easily be taken down during the course of upright proceedings, provided you cite this case law. DC Rastogi, it's a High Court ruling. There have been instances where charitable organizations get donations, corpus or otherwise. These donations were also subject matter of addition under section 68. Now we have got the section 115BBC instead of BBE. 115BBC has come into play. So even before income can be caught under the clutches of section 115BBE, it has to sail through the section 115BBC. So if assessee is able to disclose the fact that it is from this and this source, I think anonymous donation related provisions can be surpassed. But it can never be subject matter of addition under section 68. These are the case laws, very authoritative ones, which is put on the slide. But assessing officers can find one or the other way to bring it to tax under section 115BBE, tax rate being the highest. So in this case, there is a Jabalpur based trust received a donation from 3 Kolkata based companies, private limited companies, as if those companies were incorporated to donate to this trust. The moment they donated, in no time these trusts were struck off. It's not winding up, not voluntary liquidation, nothing as such. They were struck off from the MCA records. These companies had no obligation under CSR, so it's like donate and cease to exist. So assessee was able to prove the identity, whatever is required under BBC, assessee could justify. BBC is mere paperwork. The real crux lies in section 68. The onus that is cast upon the assessee under section 68 is very burdensome. Assessee could not survive. So despite the fact that it is a donation, despite the fact that it was disclosed in the books of accounts of the assessee trust, despite surviving 115 BBC, assessee was subject to tax at 78% or whatever tax that existed back in those days. This is just to emphasize, found credited. Lakshmi Chand Baijanath is the case law which has been often cited. Any submissions which I prepare on 28 versus business income versus deemed income under section 68, I cite this ruling, very comforting to cite this ruling. This ruling appreciates something called as there can be undisclosed business income as against a cash credit. A cash credit is basically undisclosed income. So appreciate the phrase which is there in the heading, members, undisclosed income which is liable to tax under section 68 versus undisclosed business income which is liable to tax under section 28. So if a credit is found in the books of accounts of the assessee which is engaged in business, it is not unreasonable to infer that it is a receipt arising out of course of business of the assessee. One favorable ruling, one adverse ruling. So we had Lakshmichand Baijanath. One more Tejpal Singh is a favorable ruling. Assessee was engaged in pharma business. They say since revenue was unable to show any other source related to excess cash, the excess cash was from business and 115BB has no application. So with a due respect, there is something called as per inquirium. Ruling has been passed without proper application of mind. So they are casting obligations on the assessing officer. It is for the assessing officer to prove source excess as to how assessee has derived excess cash. King Pharma is something which I respect. King Pharma is a ruling of Punjab and Haryana High Court, very judicially active bench of High Court. The assessee surrenders during the course of survey. Because assessee just makes a surrender and takes comfort of the ruling which was referred in the previous slide. If assessee is not able to prove the source as to how he has got this, it was a case of excess stock. If assessee is not able to explain as to the source of the excess stock, addition can still be made under section 69A. So this is also a pharma company. Excess stock is actually out of business, but it is excess stocks. It is beyond what is recorded in the books of accounts. Not as a matter of right, we can say that it is to be assessed under section 28. And what's the use of section 68? Explain the source, only then come out of clutches of section 68. Very authoritative ruling. Despite that, we have a couple of favorable rulings which have been referred on the slide. Fakir Muhammad Haji Hassan reminds me of one famous lady who was coming from Dubai, I suppose, with a lot of gold, confiscated. We all know that. Such incomes, how is that it is treated? If assessee is engaged in business, if assessee is able to explain the nature and source, take it under the purview of section 28, heads of income. We have section 14 which says, save as otherwise provided. Here are the 5 heads of income. So it's only when you explain nature and source, bring it to the purview of respective heads. If it is not so, bring it under section 68 to 69C. So the very initial phrase which is there in section 14, it says save as otherwise provided. So it is not just this 5 heads of income. There can be much more beyond 5 heads of income, these 5 sections, 68 to 69D. So it is very well placed, nicely placed in income tax provisions. What is highlighted in bold, though the gold was seized, assessee wanted to claim it as a business receipt and the corresponding expenses. Though the gold was seized, it was so held that no benefit of expenses, because we all remember from the first 5 minutes of our presentation that we had subsection 2 to section 115BBE which barred us from expenditure, allowance and set off of losses. So despite that section not being there in place, section 115BBE has come into place since 2012. This case law is 2001. So despite that section not being there in place, no deduction on account of expenditure, no deduction on account of confiscation. After all, where is that you can claim deduction? In respect to computation mechanism, computation sections. That sections are not applicable in the first place. Hope members are able to appreciate. Anyway, found credited, we have some more support from authoritative rulings. Devi Prasad, Vishwanath Prasad. So it's a double Prasad. Basically it says if you are able to prove the source and indicate the fact that it has been taxed, there cannot be addition under section 68. Instances where the incomes which are disclosed under the head business are being challenged by the assessing officer. I give a sales register, assessing officer asked me to provide a list of maybe names along with PAN and address of the customers. I'm sure many assessees and representatives here would have come across instances where assessing officers are asking proof of purchases and also sales. That is not required. Where is it required? Under the provisions of income tax. But for section 269 SSST and 269T, where is the requirement? The second point which is on the slide, in the case of cash transaction, where delivery of goods is taken against cash payment, it is hardly necessary. So assessing officers can ask, as long as I have undertaken business, that an income needs to be parked under section 28, can never be taken to section 68. Even if you are not provided the list of assessees, list of customers, clients, as the case may be. However, again, one favorable case law, one adverse case law. The intention is not to confuse the members in this hall. The intention is to appreciate the fine language based on which ruling has been given by courts. So in the previous instance, we had Jasera ruling, wherein it was mentioned that there is no need for you to collect hell lot of details of the customers. We have ruling in the case of J&J Essential Oil. This company, I do not know the turnover that was disclosed in the return of income. In one particular month of 2 years, 2 years was the coverage, I think it was pursuant to search. In one particular month, this company clocks a turnover of 3.12 crores just by selling one product, apparently on test basis. The question was raised when it comes to the genuineness of the sales. Why would assessee stop sales of a product which has clocked that amount of turnover in a month? Why not extend it to another month? This is the finding. Why only 1 month? Why not 2 months? So if I do it for 2 months, will I come out of clutches of this ruling? So despite the fact that it was disclosed in the books of accounts, assessee has paid taxes on that particular sales of 3.12 crores. Despite all that, because of suspicion around it, nature and source. What is nature and source? We will cover it. Suspicion around it, suspicion on genuineness of the income, it was reclassified as undisclosed income, section 68. So what is the obligation cast on the assessees? Some more case laws. In the interest of time, we are done with 1 hour, and which slide is this? Slide number 45. And remember, we have 175 slides. So some more case laws of all jewelry houses, a lot of good case laws on the fact that if it is a business income with a genuine source and nature, it cannot be brought under section 68. These are the case laws in support of assessments. Disclose the sales, no double addition. Okay. Gist of case laws. Axon Global is the most authoritative ruling post demonetization. The assessee there is a trader in dry fruits, deposited close to about 160 crores. Some good comparative exercise was done. What was the sales last year? 1 crore. What was the sales during demonetization? 1 crore. Okay, fine. Then month on month exercise. What was the sales in April 2016? It is 1 crore. What was the sale in May 2016? 2 crores. Or rather, it was noticed that there is 1000% growth month on month. That trend was there pre-demonetization. That trend was there post-demonetization. So nothing off track, nothing surprising. Complete set of books of accounts were produced. Stock details. Usually in the tax audit report we have a disclaimers, but in that case, stock details were clearly mentioned. You does not raise any suspicion, no doubts, no whisper on the books of accounts. No evidence of bogus sales, no evidence of bogus purchases. Only the cash that was deposited during demonetization, only the sales clocked during demonetization was subject matter of debate under section 68. Why? Because it is 160 crores. And why again? The cash on hand was deposited with various banks. Why is that assessee did not deposit that money in one go? Is there a suspicion? So assessing officer wants this company which is clocking turnover only during demonetization or rather had a cash of 160 crores. He wants this company to deposit this money in one go. That was the suspicion. And one more last point is also something to be appreciated. Despite having huge bank loans servicing interest, why is that assessee sitting on 160 crore cash? For these two reasons it was, so it is for the businessman to decide how is that he wants to conduct his business. Taking loan, paying interest does not mean that cash is not there in the business. Does not mean that assessee has not clocked the sales. So when assessing officer is not able to pinpoint error, any mistake in the books of accounts, when the VAT returns have been certified by sales tax authorities, no addition. So huge relief was given to the assessee, and this is also the ruling which is quite landmark, which is often referred when it comes to business income versus incomes under section 68. I will only refer to the first possible phrase here and the last possible phrase. Members should tell me as to what is that, if it is ringing any bells. So the tally software pinpointed, this is the ruling, this is the extract of the ruling. Tally software which runs on XYZ, rarely one finds audit trail. And then down to the last sentence, the time has come to also look into the usability of such accounting software by the regulator. And when was this ruling rendered? It was rendered in the year 2022. Rather, 2020 is the IT ruling. High Court upheld in the year 2022. And what is that we had from the MCA? Not surprised. So despite giving relief to one assessees, this court had these findings wherein it was fought by the regulator and we had the amendment or whatever circular. Hira Panna Jewelers, average daily sales is 20 lakhs. Average sales during Akshaya Triti, Dhanteras, Yugadi is 1.5 to 2 crore rupees. But sales made in 4 hours, 8 p.m. to 12 midnight, was 5 crores. Not once the department went to the assessee twice. They didn't find anything during the course of survey. They wanted CCTV to be maintained. Where is the requirement under income tax? CCTV. Assessee conveniently said 15 days. Every 15 days the data is erased. Customer details were asked, not there. Where is the requirement under income tax to maintain customer details? Name, PAN. Imagine going to Pai Hotel down the line. Imagine going to Chandrika Hotel, and the moment you order idli, they are asking you name and PAN and address. Where is the requirement? Assessee had clocked a genuine turnover merely on the basis of surmises. How can 5 crore turnover be clocked post demonetization? Just a few hours. Nonetheless, no surmises. We all remember from the previous slide, addition cannot be made on estimate basis, ad hoc basis, whimsical fancies. Show me the data. No defect in the books of accounts. 2 times the survey numbers. 2 times. And what was referred there to overcome the ruling which was referred in the previous slide, Serum and JMG essential oils. Sales of how much? 3.12 crores in just 1 month was frowned upon. Here sales of 5 crores versus average sales of 20 lakhs is not frowned upon because it was so cited in the newspaper reports. Newspaper reports was acknowledged by the Honorable Vizag ITAT to say that every jeweler enjoyed or the demonetization was some sort of festival, nothing less than a festival for jewelers. So it's believable that assessee has blocked 5 crore rupees. So cash of 5 crore rupees. 270 invoices, very interesting case. Every case on demonetization is interesting, rather every case of section 68 is interesting, or rather every case of income tax is interesting. Nothing less than a movie. Anyways, moving on to the next phrase, any sum be deliberated, found credited be deliberated in the books is the third phrase. I am afraid of the ticking bomb, hanging knife. We are still in the third phrase of the first section. So in the books, we all know chartered accountants, what is books. Books has been defined. I will only stress on one phrase here. books includes, it's a inclusive definition, day book, cash book, account book and other books. Previously it was emphasis was only given to physical form. Post amendment came into play 2022, long after we adopted electronic means. This amendment is highlighted, put in bold, increased font size. This was to overcome the ruling of Chennai Tribunal in GSNR Rice, wherein the entries deleted from CPU was subject matter of edition. Though it was a favorable ruling, I think amendment has been done, but I fail to understand as to how this amendment arrests the deleted sections, deleted entries from the CPU. But nonetheless, section 44AA, section 2 within bracket 12A deals with what is books of accounts. 44AA deals with the purpose of books of accounts. The purpose of books of accounts is to assist the assessing officer to compute the total income of the assessor. Before moving on to the usage of books of accounts, the last point on the slide dealing with other books was the phrase which we emphasized while dealing with definition. Other books does not include the diary, loose sheets is what GSNR ruling has stated. So anyways, existence of a book is a precondition to remove section 68. If there is no books of accounts, no addition can be made under section 68. Huge compilation of cases. I've just put it down to close to about 6 case laws. Certain case laws that are against assessing is something to be appreciated. During the course of assessment proceedings, when called for books of accounts, assessee says we are in the process of collating information documents. We'll submit it tomorrow, 1 week down the line, 1 month down. So they kept on pushing this requirement of furnishing the books of accounts before assessing officer. It is only during the course of appellate proceeding they say that I have not maintained books of accounts. Quite misleading. Actually, court came down heavily on the assessee. Supreme Court. They had to go to Supreme Court to get this kind of relief. Be it either assessee or MU, they have to go to Supreme Court. The second instance is that of an assessee. He is required to maintain books of accounts. Section 44AA dictates as to who is required to maintain books of accounts. Does not maintain books of accounts. Can he take comfort of these rulings, first few rulings which are there in the slide? Can he take comfort of the ruling saying that no books of accounts, no section 68? No. You cannot take advantage of one's own wrong. You cannot maintain books of accounts, suffer penalty for that, 25,000 rupees, also suffer addition to section 68. So it reminds me of this ruling which I had referred even before I could refer to section 68. Jadu Hari Dalbia. Says section is only fortifying what is already there in the act. You are required to explain nature and source. If you are not required to explain, if you are not able to explain nature and source, if not section 68, I can still tax it.
In case of 4480 cases, how section 68 is enforced in assessments?
Sir, what sites are dedicated for 4480? Very relevant question, sir. On one hand, benefit is given to the assessees. 4480 can never come under section 68. So all those cases which I want to refer on those sections, down the line, 69 I am referring, sir. So on one hand, relief is given to the assessee. Offer 8% or 6% as the case may be. On the other hand, there are assessing officers requiring you to explain each and every entry which is appearing in the bank account. They are asking for nature and source. All that I am required to do, the gist of case laws which are there in the subsequent slides. Total sales is 1 crore rupees. Total cash deposit in the bank account is 1 crore rupees. I will say it through. Good number of case laws are there. I will say it through. But if I have an asset beyond 1 crore rupees cash deposit, or if I have an asset of 2 crore rupees and want to take comfort of section 4480, though it is possible, sir, you may have also disclosed income under 4480 in the previous years, and possibility of you accumulating all those incomes and putting it in an asset is possibility is there, but it is going to be very challenging before assessing officers to convince that 6% or 8% accumulated for so many years without expending it for personal purposes, leading to an asset. It's not a sales receipt, asset worth 2 crore rupees. So it's going to be a difficult task. Some more case laws, we can complicate each and every phrase which is there in the section. This one case law, I think we are done with books of accounts. Interesting observation by the Delhi Tribunal. Whether bank account is a books of account of the assessee is the question here. Good number of cases in the subsequent slides stating that bank account statement is a statement of Siddesh maintained by SBI in their books of accounts. So it's not my books of accounts, it's their books of accounts. Now what's the relation between me and the banker? It's not of a principal agent, it's not of a beneficiary and otherwise. It is that of a lender and depositor. Am I right? So by and large, 99% of the cases are in favor of assessee. Again, I do not know if it is per inquirium. I do not know if it is because of lack of application of mind. The court has given this finding, even without formal books, even based on passbook, addition has been made in this case. The last sentence is something to be appreciated. Section 68 only refers to books of accounts. They do not say that books of accounts needs to be maintained by the assessee. So even if books of accounts are maintained by SBI, even if books of accounts are maintained by my vendor can be subject matter of taxation based on this ruling. Again, this is a ruling which was rendered in 2012, also followed in another ruling in 2020. But by and large, case laws are in favor of assessee. Whether loose sheets, a diary is considered a books of accounts, we have very infamous case laws. Common causes case law. Common causes, I think the people behind that is Jain Hawala diaries. Common causes is the recent one, Sahara diaries. Sahara and Birla diaries, 2017. Interesting read. BC Shukla is, I think that is where L.K. Advani and Jain Hawala diaries. They are not books of accounts. No addition can be made based on that. The recent one, as close as we can get to the local example, Sunil Kumar Sharma. Karnataka High Court has held categorically that loose papers cannot be considered as books of accounts, so no addition under section 68. If I can share my example, I was arguing a case before ITET and I was asked to produce books of accounts in the course of hearing. I said it is filed. It is there on this page of paper book. That is when bench member asked me something which left me humbled. He said, balance sheet and P&L is what you are referring. Balance sheet and P&L is only a summary of books of accounts. Summary itself. Can't agree more. And we have high courts holding that. Sheraton Apparels is the lead case on this issue as to what is books of accounts. It's something which will help you to calculate the profit earned or losses suffered during the period of time, credible data, financial position, liquidity position. This is what is books of accounts. It will help you to prepare assets and liabilities statement of accounts. What is not books of accounts is a mere compilation or collection of sheets. Even if I keep mentioning fees received from XYZ, diligently mention date-wise, name, amount, it is still not books of accounts. Will it help you to compute your total income? No. It's not books of accounts. Not diary which are maintained merely as man's private record, secretly record transaction, that is all not books of accounts. No addition can be made, members. And the sir was asking a question, I think we are closer to the answer to the question. When books of accounts are rejected, often when the notices are not being responded, assessing officers invoke section 145 subsection 3, reject books of accounts, estimate your total income. 25% of the sales is your total income. Despite that, there is tendency where assessing officers make addition on purchases under section 68. Not purchases, not necessarily 68, or the section 69C. They make additions. Not possible. When you are rejecting books of accounts, how can you rely on the same books of accounts and make addition under section 69C? Very authoritative. Very nice. How much damage can you inflict on an assessee? On one hand you reject, on another hand you use it to make addition, not acceptable. But there is no free hand. Again, one favorable ruling, one adverse ruling. Favorable was there in the previous slide. No addition can be made. 68 to 69. When you reject books of accounts. Look at this, members. Look at something which is there on the slide. This is also favorable. Thomas Appel is on presumptive taxation. It is in favor of assessee. Assessee cannot be compelled to explain expenses or other credits especially when it's offered income under the head 4480, presumptive basis. So look at this, members. Books rejected, yet addition is made under section 68 to 69C. There is no free hand. For example, when books are rejected, yes, I agree that addition cannot be made on account of trade creditors, not be made on account of cash deposits. Anything connected to P&L, it cannot be made under section 68 to 69C. But if you have received a share capital, is it a part of P&L? Not part of P&L. It can still be made. That's the crux of this ruling. Punjab and Haryana High Court, 2018. Again, this is little ill-timed. We already deliberated upon this. Passbook is not a books of account. So a lot of instances where addition has been made under section 68 on the basis of passbook. We are before first and second appellate authorities. So can an addition be deleted simply because it is not covered within the scope of section 68? Answer is yes. We have good authorities on the subject. Can it now be moved to section 69 during the course of appellate proceedings? Is the question which we will deliberate for sure. This is also equally important. In the year 2018, I get money from Ravindra Bhatt sir. He has lent me 10 lakh rupees 2018. In the year 2024, during the course of assessment proceedings down the line, they come across this entry, still outstanding balance. I don't pay it back to my friend. Can that credit? It is no longer credit. Any sum or form credited in the books of accounts, everything is there. In which year? In the year 2024, assessing officer tries to invoke section 68 saying that this credit is not explained. Can an addition be made in the year assessment year 24-25? Is the question to the learned audience. The phrase which is there in the section is, it may be charged to the income, it may be charged to the income tax as income of the assessee of that previous year. Which previous year? Is it the previous year in which you are found to have a credit, or it is the previous year in which the credit was first planted in the books of accounts? The interpretation, 100% of the case laws are in favor of assessing. If assessing officer wants to question this, bring it to tax under section 68, it can be done only in the assessment year 18-19, not in the year 24-25. So a lot of additions are taken off from the table just by this particular interpretation. Ivan Singh is the lead case. I put it on the slide. You can refer it at your convenience. So, para 11, last few sentences, it says any previous year which is referred in section 68, it is to mean as not referring to all previous years, but the previous year in relation to the assessment year concerned, in which entry is first hit in the books of accounts. Fine, members. So far, I'm afraid we are still on section 68. I would urge Bangalore branch for a few more sessions on each of the sections, section 69, 69, A, B, C. I will be failing in my duty if I don't value each and every word, each and every phrase which is there in section 68. So as I mentioned previously, we were wondering a situation where addition is initially made by assessing officer under section 68. Can it be reclassified as addition under section 69? The first ruling is of Allahabad High Court, 2018. It's a recent ruling, 60 years old legislation. 2018 is no doubt a recent ruling. Section is very clear. It is the satisfaction of assessing officer. When act is very clear, it is the satisfaction of assessing officer alone that is required. Can a tribunal plant a satisfaction? Allahabad High Court is very clear. Tribunal cannot do it. Tribunal cannot at a belated stage improve the order of assessing officer and convert an addition from section 68 to 69D. So if an addition has been made on the basis of entries in the passbook, it can never be made based on these rulings. It is done and dusted if it is time bound. It cannot be reclassified as addition under section 69. The question is again, okay, ITET cannot do it. Can assessing officer or rather C8 appeals, can they do it? C8 appeals, we all know that C8 appeals have a co-terminus power that of assessing officer. Both have the same powers. CIT can do enhancement, not just reduce the assessment. So can CIT appeals do this? Is the question that was posed. Bangalore ITIT has rendered the finding. I am not able to find the citation, and I am not hallucinating it. This is not from ChatGPT. This is the ruling which is there. Hopefully I will find this citation. They say even CIT cannot do this reclassification. When Act is very clear, 116 is very clear that assessing officer is different from CIT. DCIT is different from ITO, TR is different from inspector. When Act is very clear, when Act is section 68 is very clear, it is only assessing officer, not CIT. So naturally you may have been able to predict my rhythm the moment I refer a favorable case, there is adverse case laws also. So we have Manoj Agarwal, 2008, it's a special bench and it is from Delhi. What more is required? Manoj Agarwal has categorically stated, it has been followed by multiple ITT rulings in the recent past, that if addition is not permissible under section 68, the ingredients, the conditions, the judicial fact to make addition under section 68, nature and source, is also there in section 69. What is the prejudice caused? If you are not able to explain, as well uphold the addition under section 69. This is the ruling. As if it was not enough, 2016 we have a ruling of a High Court, Namdev Arora. During the course of assessment proceedings, it was appreciated in this case that assessing officer in the show cause notice or even 142(1) notice never said that it is going to be made under section 68. Ultimately, the assessment order for the first time he whispers this section called as section 68. And assessing challenges before higher authorities that it is not sustainable because of various reasons. Addition is not sustainable under section 68. The court wonders what is the prejudice caused to you? How is it you are affected? Explanation remains the same, be it whichever section it is. As if that was not enough, we have one more SVS, wrong section would not be fatal. We have section 292B. Look at the sections and the case laws that are coming to the rescue of assessing officers. 292B says any mistake, non-mention of section, wrong mention of section in the assessment notice summons does not cause any prejudice. It can still be, it's a defect which can be cured. But can a jurisdictional defect be cured by invoking section 292B? It's a different debate for a different date. I would still be happy concluding today's session with section 68 by covering nature and source. It's so important. Nature and source, I can just replace a couple of words in each of the subsequent sections and still say that I covered 90% of topics given to me. The requirement of law is to explain nature and source. If you remember section 68, assessee is compelled to explain nature and source. What is nature and source? So two simple words, no guidance under the Act. Thankfully, we have 1963 ruling of Supreme Court. They say nature and source can be explained. Khaled Khan Mohammed. It says by proving identity, creditworthiness, and genuineness. Again, three simple words. As if two were not enough, three were brought into place. Obligation is noted on the assessee. We have Evidence Act. We have DSM, Bharatiya Sakshya. What is that word? Act. So how is that we can identify, we can establish the identity of a person in whose name credit is standing in my account? One as simple as name, address, PAN, invoice, agreements, confirmation letter, affidavit can also be given if you don't have any other documents. I was thinking of a situation, is there any situation where identity of a person can be disputed? One is if you don't produce documents, if you just put any Ram, Sita names, it can definitely be disputed. The second instance is even if I prove identity of a company, if the company is later struck off from the MCA records, can identity be questioned by the assessing officer? Again, untested, not tested, but we had one ruling of anonymous donation where companies were struck off with the subject matter of section 68. Identity, I don't bother much members. It's a easy task. It's a cakewalk. On the creditworthiness, what are the documents which can establish creditworthiness? The first and foremost reply which I get from assessees when I ask for creditworthiness is, sir, bank account al bandide transaction. Correct? This has come through banking channels. Not enough. I can easily list down from this very same PPT at least 10 case laws which have held that transactions through banking channels, no section 68 edition, creditworthiness is proved. 10 more case laws on the very same PPT. Mere routing of transaction through banking channels will not establish creditworthiness. We already covered few case laws in the past, donation, whatnot. So we have Supreme Court ruling, again not stressing much on the ruling. Bank transaction trail is not enough. Financial statements of whom? Financial statements not that of assessee. Financial statements of person in whose name credit is standing in my account. So I have raised money from Shukumar sir by way of issue of share capital. It's not my financial statements. Shukumar sir's financial statements are required to be produced before the assessing officer. ITR of whom? Shukumar sir's. And let us suppose there is an assessee who has invested 1 crore in my private limited company. And assessee produces ITR. That year, unfortunately, he has earned just about 10 lakhs rupees. Don't you think there is a possibility of he raising this 1 crore rupees from multiple credible sources and investing in my company? But there have been hundreds of instances where income of that year has been compared with the investment, 1 crore versus 10 lakhs. It is not apple versus apple comparison. They can even borrow from credible sources from banking institutions and invest in a company. Am I right? So these rulings will come to my rescue. Income of creditor is low as compared to the corresponding transaction, but their bank statements clearly show they had funds. So mere low income cannot lead to addition under various sections which have been referred to. Statement of assets liabilities, source of receipt of funds. This is what we have been taking comfort of. Section 133, subsection 6, section 131. Look at the findings of the case law. It's a recent case law 310 ITR. It says where respondent assessee. So if I am not able to explain the nature and source of my creditor, I can request assessing officer during the course of assessment by giving details of identity, and ask him to issue summons under 131. Ask him to invoke section 133 subsection 6. Approach that person directly, or having his PAN, log into your ITBA system and look at his status, look at the number of banks he holds. None of the inquiries are caused by the system officer. If it is not so caused, addition cannot be sustained. We have rulings. So hope members are able to appreciate 133.6 request assessing officers to serve it on the creditor. Because where is the legal compulsion? So if I ask my investor, can you view your ITR, financial statements, bank account statements to prove creditworthiness for the purpose of section 68, he says, why should I give? And what is that I have to explain? Only 2 words, nature and source in the act. Beyond that, what is that I have? Where is the legal support? Where is that I can show him a document saying that these documents will help me to come out of the clutches of section 68? No support. Look at the helpless situation of the assessee. Again, 1971, still sense has not prevailed. 1971, this Allahabad High Court appreciates that assessing officers should assist the assessee by exercising powers to enable the assessee to produce evidences. Otherwise, the entire assessment, the observation needs to be appreciated. There is a new unit called as verification unit. Request assessing officer, reduce basic details and request him to refer the matter to the verification unit and get it verified. If he is not doing that, some case laws will come to my comfort, support. But at least some basic duty has to be discharged by the assessee. Otherwise, what is required to be proved under section is just a prima facie creditworthiness, not source of source. This has been appreciated. Good number of rulings are there on the slide. But there are certain exceptions. If it is a case of first proviso, if it is a case of loan, borrowings and such other amounts, and if it is a case of closely held companies raising share capital, you are also required to prove source of source. Hope members are able to appreciate. Pardon me for the speed. verification unit we just referred, 133.6 we just referred. There are instances where we casually ask assessing officers to do his part, and there are few diligent assessing officers who diligently issue 133.6 notices to all my secured creditors and lenders. There will be instances where they don't respond. Assessing officer will say, you asked for it, I have served notices on them, they didn't respond. All the more reasons to sustain the addition. It's a double-edged sword. But I can still survive the addition under section 68. If I am able to discharge the obligation cast upon me, produce a good amount of credible documents, you can still survive. The last case law, more than 15 years have elapsed since the relevant accounting years. It's very difficult to summon the SSCs, ask for source of source water. The courts have been reasonable, quite reasonable. So the SSC here, to discharge the creditworthiness, he produces complete address. You are able to see the most pointer? Complete address, GIR number, which is equal to PAN number, copies of assessment order. He has proved the capacity of the creditors merely because the summons issued on the creditors were not served because of change in address, or they have chosen not to respond, does not necessarily lead to addition, is the crux of this ruling. While KACA has been making representation, I think Institute DTC board also makes a representation on multiple occasions. If KCCI makes a representation, CCI makes a representation, we have BCAS, multiple institutions making representation, we hardly got a reply. One person, Ashmir, he tweets after 60 years of existence of this law. 60 years, 1971 is when this law of section 68 was introduced in the provisions of section 60 in the Income Tax Act. Till date, there is no circular stating that you provide these documents, creditworthiness is proved. You provide these documents, identity is proved. Genuineness is a different devil to be addressed. There is no guidance at all. But this person tweets in the public domain, tweet on account X. He says, how is it I am expected to give all these documents of my investors? Then there is immediate reply in a fortnight's time, not even a fortnight, in a day's time, there is a reply by the Income Tax Department, the reply is on the screen. They say, if it is a case of a shareholder, investor, who is a resident what is referred? What is the document they are asking for? To discharge identity and creditworthiness? What is the document, members? PAN. Just to provide PAN. What a special treatment to the startup world. What about unfortunate assessees in the retail, wholesale, chickpeas of the world? Can I dare to provide only PAN, ask assessing officer, delete addition of the section 68? I dare not. Which assessing officer, which CIT, which ITT provides this relief? Or at least today, can I take comfort of this particular case law and represent before ITT? This is not in a case law, slip of words, slip of tongue. It's a tweet by Income Tax Department. Where is the guidance, members? Where is the compulsion for the other person to produce documents to me? Private records. Look at the obligation cast upon the assessee. Like section 56 to 7B has been put to rest because they were not able to distinguish the assessees who are shell companies. Shell companies, they have huge paperwork. The moment they give loan, they give confirmation, they give ITR, they give bank account statements, they give every other document which you want. Click of a button. Genuine assessees are not able to produce. So 56 to 7B angel tax, they were not able to segregate genuine assessees from shell companies. It was leading to misapplication. They put it to rest for good reasons. 69, 70, 80 years of existence, still not serving purpose. Black money still there, 78% tax rate, still not serving purpose. You might as well. What is the solution, members? In our portfolio, this is also a case law which appreciates the difficulty which lies in proving the creditworthiness of a person. But anyway, it's all academic. They say that it is to be applied in rarest of rarest cases. But which assessing officers follows this? As I mentioned previously, genuineness of the transaction is a different level to be addressed. How is that going to prove that this loan that you have borrowed is genuine in nature? I cannot cite even a single document, I cannot cite even a single situation which can help you to prove, but a couple of case laws where the provisions were abused. In the case of Sumiti Dayal, very infamous case law, wherein a test of human preponderance was laid by the Supreme Court. This lady had never played a jackpot, a lottery in her life. She starts off in the year 1969 with the first possible ticket. Ticket number 1 to ticket number 13. All 13 tickets, she wins the jackpot. She presents it to the vendor and she gets the money, deposits in her bank account. It's a subject matter of debate. So this case law is 1995. The assessing officer called upon assessee to produce multiple documents. The paperwork, it's a dummy transaction, paperwork is beautifully done. She even had lottery tickets. And look at the success rate. Nobody till date, I think, can match that success rate of 13 lotteries back to back. That is when, as I mentioned, theory of human probability. What are the chances in the real world for a human being to earn such income on a regular basis? 13 lotteries. And even if assessee has this good winning streak, why is that assessee did not continue in the subsequent years? Those are the questions that were posed. So all the paperwork was ignored. The test of the genuineness was applied on the assessee and the transaction was brought to tax. It's only academic. Again, 1991 case law. How the assessing officer has to conduct when it comes to addition under section 68 among other sections. Assessing officer cannot start assessment with any preconceived notion. This is where I will stop. To say assessing officer cannot start with preconceived notion. Today when I get 142.1, they list out all possible transactions, items in my credit side of, in the liability side of the balance sheet and ask for supporting evidence. They list all possible items in the expense side of my P&L and ask for supporting evidences. Income tax website permits you 5 mm. Supporting evidence, whether it is a 1 crore company, supporting evidence, whether it is a 500 crore company, just furnish. And investors, whether you have 10 investors, 20 investors, furnish all ITRs, financial statements. So, where is preconceived notion? Where is all this GAN? Where is taxpayer charter? I don't know if you are all exposed to taxpayer charter. It's a very nice document. As if this was not enough, let's suppose you furnish all documents. The submissions that we prepare during the course of assessment proceedings as a reply to essay and reply, 10-20 pages average, we put all case laws and all. The assessment order, the order says one line, submissions of the assessee is not found satisfactory. Addition under section 68 is upheld. Coupled with 115BB, coupled with initiation of penalty, 156 notice. 156 notice has line by line threats. Pay within 31 days, don't pay 220 interest, penalty, 221 penalty. All that is based on what? One line. The reply of the assessee is not satisfactory. Am I right? Have you come across such orders? I'm sure members will have come across. Again, SR Mumbai case law. What is satisfaction? It is not a personal whim. It is not wish, it is not view or opinion, which is a big horse material, but a legitimate, who is doing the audit of assessment orders, especially the assessment orders which are upholding deviations. Then we have one more case law which says the onus cast upon the assessing officer needs to be discharged in a cogent manner. Again, good amount of theory, members. What is satisfaction of the assessing officer? This shifting of onus is a concept which needs appreciation. The moment I am called for explanation under section 68, I established nature and source by producing documents around identity, creditworthiness and genuineness. After that, the onus which was cast upon the assessee under section 68 is now given to the assessing officer. The assessing officer cannot casually say that he is not satisfied. He is required to go above and beyond. The assessing officer is required to make proper inquiry. This is not me who is saying this. There is authority to case laws which are of the opinion that assessing officer is required to examine the identity, creditworthiness, genuineness of the transaction and pass a speaking order in a reasoned manner, in a cogent manner, because he is not just an investigator, he is also an adjudicator. He is not just an adjudicator, he is also an investigator rather. So he has to cause inquiry. Whether if assessing officer is not causing inquiry, the addition is to be deleted. Good number of case laws in support of assessee. Couple of other legal issues, members. Whether addition can be sustained in the hands of legal heir. In case of deceased assessees, I can refer to the case laws in the context of section 54 series. If there is a requirement to make investment in the name of assessee, it is assessee alone. But again, some case laws are there in favor of assessee. Even if investment is made in the name of wife, children, the case laws are in favor of assessee because it is an exemption section, it's a beneficial section. Not so strict interpretations are operated there, but section 68 is a legal section, it's a deeming fiction. Has to be given strict interpretation. If the explanation is called from the assessee, it is assessee alone who can explain, not their legal heir. I will not stress much case laws here because I don't advise. 68 has a discretion even if there is no proper explanation. This is very comforting, members. Even if there is no proper explanation, the section is very clear. It may be charged to income tax. But if you refer to income tax bill, which is being deliberated, recently there was a select committee visiting Bangalore, soliciting views from experts. The discretion which is there under section 68 in the new bill, members, that discretion is not there. Previously, even if explanation is not tendered by the assessee, depending upon the circumstances of the case, there was a possibility of deleting the addition, not making the addition in the first instance by the assessing officer. The discretion was given. And the new bill, there is no discretion at all. The moment new bill was introduced, the first possible section which I could refer is section 68, corresponding section I think section 104. But for rearrangement of sections, every word which was there in the previous regime, which is there in the current regime, is also there in the new income tax bill. Every word. But for this, may has been replaced with shall. So the very discretion which was given to the assessing officer has been taken away. Now, what is the use of deliberating on may and shall? Because we are going to face a new income tax bill, act rather, wherein this particular thing is removed altogether. So now I am just done with 3-4 lines of section 68, preamble of section 68. Moving on to the first proviso of section 68. This is a recent introduction. If there is any loan, borrowing or such sum, look at the wide amplitude that is given to the section, by whatever name called, and any explanation offered by assessee shall be deemed to be not satisfactory. Again, deeming or deeming. As if there was the deeming was not enough in the preamble, additional deeming. So though you are tendering explanation, section states that it is deemed to be unsatisfactory unless you prove the following points. The first one is the person who is in receipt of such credit, the person in whose name such credit is recorded in the books of such assessee also offers an explanation about nature and source. So Manjunath Halur sir has lent me money. Previously I was only required to explain nature and source when it comes to my point of view that it is from Manjunath sir. And if assessing officer is reasonable, you could have spared me because may has been used in section 68. It may be added. Now section, if it is a loan, The proviso to section 68 requires me to not only explain nature and source when it comes to my angle, it also requires me to explain nature and source from his angle. So I am required to explain the source of source. He is first of all doing a favor by lending me money. Then I am asking him his ITR, financial statement, bank account statements, what. Where is the obligation? With what face can I approach Manjunath sir requesting these documents? And we are not stopping there, members. One more condition, and such explanation in the opinion of assessing officer, discretionary, subjective. The apprehensions which were there while challenging before the Delhi High Court, which was there in the first few slides of my presentation, that wrong application of this section, apprehensions on misuse of the powers of high tax rates, continues for years together. Just one example of what is the requirement of the law. This is 2018 case law. Prior to insertion of first proviso has been renumbered. This lady Seema Jain raises money from PTPL. This is where this case has to be, this is where the sections have to be applied. This is where the nature and source can be called for, or source of source can be called for. Seema Jain raises money from this company PTPL. First point I mentioned, this company does not have any tangible or intangible fixed assets. The second point I mentioned that it has a declared income of 10,000 rupees. First year, second year is 50% less, 4,600. And assessee has filed a copy of assessee has failed to file a copy of P&L account. Again, raising doubts on business activities of PTPL. So this is where this company, without any wherewithal, just about 48 lakhs rupees of share capital, has been successful in raising share premium of 18 crore rupees, only to do what? To lend money to Seema Jain. So, though there was no requirement for source of source back in those days, 2018, this case law, still law required her to prove prima facie creditworthiness. She was not successful, addition has been applied. Now that there is a requirement to prove source of source, imagine the requirements of the assessing officer. This amendment has come into play thankfully from assessment year 23-24. The interpretations that we have been having so far, law is made applicable from this play. It cannot be given retrospective effect. So far, whatever loan transactions, whatever borrowings, whatever such amounts I have, such transactions I have undertaken, I can conveniently refer to first proviso to say that I cannot be called upon to explain source of source. Yes, members? This is the only silver lining which I can cite from this case. Prospective, why did it? The second proviso, I think, on time, how many more minutes? 7 more minutes? Sir? 10-15 minutes, and I am on slide 95. I have slide 174. Yes. On dot, we came here inside this hall, 6 p.m. sir. With your permission, 8 p.m. I conclude my presentation, sir. The second proviso, members, the second proviso is to do with closely held companies raising share capital, share application, share premium. The obligation of proving the source of source, which was there in first proviso, is also extended to such assessees. Third proviso I don't have to discuss, thankfully. Second proviso has come into play from 2012. Good number of case laws referred there. Issue of share for a consideration other than monetary consideration. Good number of case laws. So money not hitting your bank account, whether it is second proviso dealing with share capital, whether it is the first proviso dealing with loans and borrowings. I cannot imagine a situation of borrowing money, loan, and money not hitting your bank account or cash. Whether it is a preamble, if there is only a book entry, if there is only a journal entry, no addition can be made under section 68. Good amount of support. Supreme Court is also referred on the slide numbers. Prior to introduction of this amendment, post introduction of this amendment in the year 2012, the assessee during the course of assessment, in this case, Mumbai Tribunal, has admitted the fact that I am not able to prove the nature and source and creditworthiness. They admit that I cannot ask my investors to provide their ITR, bank statement, etc. But they provide basic documents and ask assessing officer to conduct further inquiry. There is a department which is referred, it is called as FT and TR. Anybody who is exposed to that, FT and TR. If it is a case of issue of share capital from to a non-resident investor, we can request FT and foreign tax and tax research is a department. They in turn approach the corresponding authority entrusted with the taxes in the other country and request for relevant documents. So what is highlighted in red once again depreciate the inaction and the non-application of mind of assessing officer. When assessee is admitting, I don't have ITR of my investor, he is requested assessing officer refer to FT and TR and get the documents. When assessing officer is not doing that, addition has been deleted from this. It is the addition which has been deleted. No second opportunity. No remanding case back to assessing officer, do once again fresh assessment, nothing as such, delete. Because he has not discharged his obligations. Very landmark case on issue of share capitals. Share capital, 20 companies. Assessee approaches 20 companies, raises money from Mumbai, Kolkata, Guwahati. Good amount of paperwork done. You ask documents, it is there at your doorstep. However, when EO attempts to cause further inquiry, the notices remained unserved. However, replies came. So notices not going to assessee, but replies came through how? Through DAC, through Tapal. Look at the organized way of doing a crime. When EO does a field visit, the investor companies are not there. So they donate to a company, invest in a company, and cease to exist. Obviously, applying the Sumiti Dayal, the lottery case that I referred, Durga Prasad More, genuineness, creditworthiness not established, whole thing is subject matter of addition. I think this is where we can end today's presentation. Anyway, section 56 to 7b is not there. 56 to 7b is also some sort of a deeming provision. Excess share capital was subject matter of addition of the section 56 to 7b, and section 68 is where anything and everything can be subject matter of addition. So when there is conflict of section 56 to 7b and section 68, can I pick and choose? Can I ask assessing officer, don't tax me under section 68 which attracts 78% tax, tax me under section 56 to 7b, angel tax, I will happily pay 30%. The first test is section 68. If you are able to surpass the test of section 68 by proving nature and source or by proving identity, creditworthiness and genuineness, the second test is agent tax. So it's one by one as upheld by Kerala High Court. Anyway, this going forward, this is academic in nature because 56 to 7b has been put to rest from assessment in 25 countries. NR portfolio is already referred. Penny stocks is what I wanted to. I'll end my presentation with just this. There was a astronomical increase in share price of the company, 4,910% increase in a period of 5 months. So the assessee claimed LTCG benefit by investing in this company. And like Sumiti Dayal, 13 lotteries, all lotteries won, she was out of game. Similarly, in this case, another lady, Suman Poddar, only one company, jackpot, 4,910%. She made money and she was no longer in the game. This company, which was subject matter of investee company, first year revenue is 00, some digits I suppose. Second year revenue is 0.99 crores. Hardly any financial establishment of that company. Despite that, this amount of money was made. Whether it is what is highlighted in red is to be appreciated, whether it is a case of intelligent investment or a simple and straight case of tax planning to gain benefit of long-term capital gains. So the income otherwise exempt under section 1038 was reclassified as income which is undisclosed under section 68. So this assessee suffered addition because I have 2 more minutes. We have another lady, Swati Bajaj. Somehow came out of the clutches of addition. So there is no breadth of rulings members. Multi-bagger. So look at this flight of case where Suman Podar was distinguished. Despite the fact that SSC had done the transaction, because the SSC had done transaction in online platform of BSE through a registered stockbroker, though there was some price manipulation, it can only lead to suspicion, which can lead to further inquiry by the assessing officer. That itself cannot lead to addition. This is the trend in rulings when it comes to multi-baggers, penny stocks. So share price increasing suddenly, good suspicion, pick it up for reassessment, scrutiny, cause further inquiry. If SSC is not involved in this, if there is no cash trail that is established by the assessing officer, all high courts, if not tribunals, are in favor of SSC. So with this, I conclude my session. There is lot to discuss 60-year-old legislation, but I think possibly of time. I thank Bangalore branch once again for this opportunity. I thank all the attendees for bearing with me for 2 hours. With my apologies for not being able to cover remaining number of slides, with the hope that there will be any opportunity in the future to deliberate upon, because these sections are here to stay. Even in the new bill, the same set of sections are there. So in a nice future opportune time, we will reassemble them. So this back to you, sir. Thank you, sir.
Thank you, Siddesh, for that enlightening deliberation on the subject. Recent judicial pronouncements, section 38 to 68 to 68. Members, I, on behalf of the management committee and on the members here present, I thank the speaker from the bottom of my heart. May I call upon the chairman, C.A. Manjunathan, to present the memento to the speaker as a token of appreciation and gratitude. Members, let's join our hands. Thank you all. Thank you one and all. Have a good night.